All right, very good. Thanks for having me. I appreciate the people over at Investor Inspiration. They provide these amazing events, bringing some of the best traders from around the world. It's just, it's so great. We can do this from the comfort of our own home. Back in the days of yore, when I started trading, we had to actually travel around the country to go see people. We didn't have these things called the interwebs. And I guess, wow, I'm really aging myself now, but yeah, I'm 57 years old. I started trading when I was 8 because my dad was a stock trader, and back then we used to have to call in our orders to our broker on a thing called a rotary telephone, and it cost $50 to place an order. And then the broker would call you back and let you know what price you got, because nobody knew what price anything was. We didn't have direct access. So things have changed a tad, and I've seen a lot of changes in the markets. And I'll tell you, it's exciting. It's never been a better time to be a trader. So here to share with you some things about timing the markets, and that's a very, very important aspect of trading. W.D. Gann, the famous trader, said that trading is essentially about two things: the confluence of price and time. And I studied under one of the great psychoanalysts of history, found it extremely fascinating, and so I've made it a very important part of my trading now, and would love to share some of this with you today, which is what I'm going to do. So let's jump right into it a little bit. First of all, you're welcome to ask questions. I've got my question box up there, and I can see, I'll glance over there once in a while. If you have a question about what I'm talking about at the moment, if I'm being unclear or you want a little clarity on something, feel free to type it in. Otherwise, let's wait for questions until the end, simply because this is only a 45-minute presentation, and I want to make sure I get through all the material. If I take a lot of questions, then I've done that before, and it slows me down, and I don't get to the end. And we're on a schedule here. We have other speakers, so very important that we stay on schedule. Please don't trade with money you can't afford to lose. Very, very critical that you don't trade with money you need for your house payment, car payment, kids' college education, your retirement, etc. All information in this presentation is for educational purposes only. Please don't take it as investment advice and use the information at your own risk. By the way, in case you didn't know, trading is really, really risky. So professional traders like us, we actually put more emphasis on risk management and money management than anything else. This is one of the big distinctions between professional traders and amateur traders. The amateur traders are generally looking for, the magic indicator, the holy grail, some sort of incredible price pattern that wins 99% of the time, or they would prefer 100% of the time. That doesn't exist. None of that exists. Professional trading is more about money management, risk management, and creating a probability scenario, which I'll go over briefly how I do that. So the truth is, however, most people don't make any money, so this is an anti-hype webinar. I'm not going to tell you all these people are making trillions and trillions of dollars. No, the fact is most people lose money, so just being real transparent here with you today about that. And you need to know that. That's important for you to understand as you come in, because, of course, that begs the question, well, how do I become one of the minority? And the place you start there is with your mindset, your approach. Come in understanding that trading is not get rich quick. It is a real profession. So just like any other profession, if you're going to become a, doctor, lawyer, CPA, whatever, you're going to take a few years of study. You're going to have to be a good student of that education, go through the education, just like you have to take tests and finals and midterms and review and go over and over and go on an internship, paper trade, simulate trade before you trade with real money. And yeah, give yourself the time. Be patient, because believe me, the people who are making the money, they're professionals. And that means you've got to become a professional too and do everything that is required to have that level of skill. So, appreciated the introduction. There's my ugly mug. That's what I look like. 57 years old. I know I don't look like a day over 56, but I am. I'm also the author of Trend Trading for Dummies. I just found out I received a couple of Reader's Choice Awards from Technical Analysis of Stocks and Commodities magazine. Very proud of that. I've contributed to several other books. I've worked with other companies, training their traders. They bring me on board to help their traders make money. And so, again, just a little bit. I'm not going to talk too much about myself, but just so you know, I didn't fall off the trading turnip truck last Tuesday. There I am. So, Let's talk about two things. First of all, I'm going to share with you a brief overview of how I do establish a probability scenario when I'm trading. And then what we do after that is we're going to spend a little more time focused on one of those energies. So we're going to talk about defining the energies in the charts. And this is how I create a probability scenario for a trade. I look at 5 energies, and when I say energies, I'm talking about the energy of money. The money flowing in, the money flowing out. Order flow, you could call it, supply demand, you could call it, but to me, this is what really matters, because this is what's happening now. You've heard that past performance is not indicative of future results, and that legal statement is everywhere, and for good reason. It's true. And yet a lot of what people do, that's what they're doing. They're looking at historical results. Well, things change all the time. And what matters is, at this moment, when you're taking a trade at this second on the hard right edge of the screen, is what's going on in this auction place right now. What's the buy, supply, demand? So that's what I'm doing. I'm measuring the energy flow of money going in and out. And I break that down in 5 ways. So here are the 5 things I look at, the 5 types of energy of money flow. Number 1, and I always look at them in this order, by the way, number 1 is trend. What is the direction, the dominant energy of the market? Up or down, buying or selling, bull or bearish? And by the way, trend is always a lagging indicator, but it does tell us what is the direction at that moment. Then number 2 is momentum. Now, everybody talks about trend, and well, they should. Trend's very, very important. That's the first thing we look at, so we know which side of the market we want to be on, long or short, or maybe not trade at all. Number 2 is something that not everyone does talk about or has been taught, and that is momentum. So if you've ever had the experience where you see a trend, you get in, let's say it's an uptrend and you buy, and it seems like, oh my gosh, you know what? It's uncanny how every time I get into a trend, boom, the trend ends. It could almost be said that, you know, you can always know when the trend's going to end because it's going to be right after I place my order. That's when the trend is reliably going to end. I mean, I've had people tell me, Barry, it's so crazy. I am a perfectly imperfect trader. It is not so. It is insane how wrong I am so darn consistently. If I just turned my trading method around, I'd be profitable probably. Well, here's the problem. Here's what's going on with that. Let me explain that. So what's happening quite often when that occurs is that you just haven't been taught the difference between a strong trend and a weak trend. So trends are just up or down. It's like you walking north and your trend is north. In one step, you can turn around and walk south. So the trend can change at any second. Now, momentum is different. Momentum is like a train, a locomotive going down the track at 60 miles an hour. You put the brakes on, it's not going to stop in 1 second and turn around, right? It takes a while after they apply the brakes. In fact, that train will have to go a mile down the road going north before it's able to stop after the brakes are applied. So momentum has a forward looking nature to it, if you will. That energy follows through, and that becomes very important for us as traders because we need to have a good idea of what's going to happen after we get in. So when you trade a trend, make sure it has momentum behind it. Always ask yourself that question. Is this a strong trend? In other words, is this momentum? And momentum is defined as acceleration and weight in the market means volume. And if it's a strong trend, great. You're going to be golden. If it's a weak trend, you're not going to be golden. You're going to be dirt. You're going to be hurting. But you've got to know how to determine the difference. Number 3 is cycles. Now, this will be our main topic for 30 minutes today. But I wanted to show you what I look at because I don't even consider timing my entries and exits until step 3. So it's one part. Timing or cycles is just one aspect of your trading. No one of these energies can be used in isolation to make money. These are just all pieces of evidence of money flow that we have to put them all together in order to make money. So when do I want to get in? Most people talk about price, support, resistance levels, and that's all great. I use them too, and that's number 4. Then we look at support resistance levels. That's your price element. We want to buy off support, short off resistance, and take profits into those areas. And then the 5th and final energy I look for is what I call the fractal energy. Now that actually refers to using multiple time frames. So very common practice. If I'm taking trades off of a daily chart, I would also look at a weekly chart of the same market, and I would want to trade in the direction of that weekly chart. If I'm trading, say, a 5-minute chart, then I would look at a 15-minute chart, and that 15-minute chart I would call my fractal energy. So we're looking at the same market on different scales. All right, so how do we do this? Well, first of all, my trading is very objective and rule-based, so I have to have some instruments that measure these energies for me. I don't just eyeball a chart and say, oh, looks like it's going up, the trend is up. No, that would be subjective and discretionary, and I know some people who can trade that way, but I'm not one of them. So, and it's also not duplicable. So for trends I use a moving average, for momentum I use a momentum indicator, for cycles I use an oscillator, for support resistance I use the usual suspects that everyone uses because they have a self-fulfilling prophecy to them, and for the fractal energies I like to use a ratio of 3 to 1. So again, if I'm using a 5-minute chart, I would look at a 15-minute chart because it's 3 times 5. And that's a good ratio. If you get to 4 to 1, it's okay. If you get to 5 to 1, there's just too much play between the timing of the charts. The signals are not very tightly correlated. So bottom line is I use indicators, but I don't use them to make money. I use indicators just to give me a value, an actual number for each one of these energies, so that I have a rule-based approach to measuring these energies. So how do we make money? How do we take these 5 pieces of evidence to make money? Well, here's what we do. At each entry point, I ask myself, how many of these 5 energies are aligned, being bullish or bearish? I give each setup a score of 1 to 5 based on how many energies are aligned. Obviously, the higher the score, the higher the probability. And I liken this to taking each trade to court. So I need 5 independent witnesses to establish a preponderance of the evidence. And here's the key. Again, it's not about the indicators. I could put 5 trend indicators on a chart and I would still only measure 1 energy, trend. So these 5 energies the indicators are just literally mathematically measuring the money flow. So the key in choosing these 5 energies I listed for you is that each one is non-correlated to the other 4. And that's what makes it significant when all 5 align. Okay, so now I just wanted to give you that really quick overview. I've other webinars that are free that I go into more detail on those. But the reason I had to go over that was to give you the big picture, the big context. Now, we're going to focus today on energy number 3, cycles. A chart has 2 dimensions. That's it, 2 dimensions, right? It's a 2-dimensional object. The time axis on the bottom, the x-axis, and the price axis, the y-axis on the right. Here is the crime. The crime is that most traders have never been taught how to accurately measure time in the markets, in technical analysis. They've never been given a great timing tool. And I'll actually give you my timing tool for free. I'll be happy to do that today. In fact, I got to apologize. I kind of came unprepared. I got nothing to sell today. So yeah, I know you're bummed out. I literally don't have any offers for you today. I'm selling nothing. So at the end of this presentation, there's going to be nothing for sale. So I have to apologize up front. But what I'll do is I'll tell you what, I'll give you one of my mini courses for free. All right, and that even has a trade setup in it that you can take, use, and hopefully make money with. I mean, try it out on a simulator demo account. Makes me a lot of money, and I'll give you that trade setup in that course for free. And also I'll show you how to get my timing indicator today for free too. So today's just free information, just charity. So I hope you guys enjoy it. All right, so back to our topic here. Most traders have never been taught how to use time, how to time your entries. They're just using half of the chart. So the problem is you can't establish a probability scenario if you're only using 50% of the information on a two-dimensional chart. So that results in this common lament. Hey, I got in right after I bought, the market went down and stopped me out. Then, right after I got stepped out, the market turned around and made a major move back in the original direction of my trade. As one of my mentors at the CME used to say, retailers are often right, but at the wrong time. And that's what's happening there. So, W.D. Gann, by the way, he said between time and price, actually, time is more important than price, so it's not even 50-50. So, don't know if you agree with that or not, but I'll tell you, I know a lot of traders who once they learn how to time their entries, all of a sudden, boom, that's all they needed. That took them over the speed bump, and now they're making money. So today is just an introduction to cycles, so we're going to talk about several different types of cycles. So here's what we'll show today. First of all, we're going to go over seasonal and calendar cycles. Then we're going to talk about volatility cycles. Third, we're going to talk about one you've probably never heard of before, order chaos cycles. Very important, very important. The fourth one we'll talk about is coupling and uncoupling cycles, and then we'll finish up with up-down cycles. The up-down cycles is the one that most people think of, the market making a high, a low, a high, a low, a high, and a low. So, seasonal and calendar cycles. Very important. This is an important part of timing your entries. Now, this is a bigger picture than just the highs and the lows. So let's go back to the origins of the futures market, talk about agricultural markets. This is one of the most obvious seasonal cycles. So farmers would plant their seeds in the spring, and then they would sow and reap the harvest in the fall. And that's a cycle. So if you're investing in corn or wheat or, some of these soft commodities, what people would do is they say, oh, great, here's a cycle. I'll buy in the spring and I'll sell in the fall and I'll make money. Of course, problems with that, right? And part of the reason futures markets were born was because of this, because things would happen over the course of the summer. Climate change, freezes. I remember I used to live in Florida, and they have the orange, obviously a huge thing with orange juice down there and growing oranges, and sometimes they'd get a freeze, and that would mess up the whole orange juice market, and again, supply demand. So it's not as easy as just buy in the spring, sell in the fall. And so farmers would worry about this, and so speculators would come in and they would say, tell you what I'm going to do. I'll pay you up front for the crop in the future, and I'll pay you now, but because you're getting paid up front before any potential disasters happen, I'm assuming that risk, I'm going to pay you less than you normally would get. So I want that extra spread, I want that benefit for taking the risk, and the farmers would do it because they would say that's fine, because at least I know I'm getting money and I can feed my family over the winter. So that's one. Number two, another type of cycle is the retail sector. So this is any companies that depend heavily on retail sales. And what's quite interesting with these, we think they just, they sell, they buy, they sell throughout the year. And yeah, they do. But of course, there are certain times of the year when the retail, especially certain retail sectors, make more money than others. In fact, there's some retail companies that make all their profits during Christmas. And the rest of the year is just kind of being there and waiting for the next Christmas to come along. Or Mother's Day, right? That's another big one. So there's certain holidays, especially, when many companies will make all their money during those holidays. And the rest of the time, they're just being there, keeping their customers loyal, and so forth. Back to school specials, another one. So again, you could say, oh, well, I'll just buy a retail company right before Christmas and then sell right afterwards. And that is theoretically great, but the problem is, and if you watch Bloomberg, CNBC, whatever, they always talk about this and they say, gosh, it was a great Christmas or it was a horrible Christmas season. Part of that depends on the economy, how much money people have, and so forth. So therefore, again, it's not that easy. So you have to, and by the way, speculators, I like to use the word speculators more than traders, frankly, because it keeps in mind the risk element. And so they try to anticipate this. And so professional traders, we're always doing these things ahead of time. We're not waiting till it happens. We enter into our positions before it happens, and we're out before the news is done. So you've heard buy the rumor, sell the news. That's what we're doing. The travel sector is another one. Certain times of the year, summer, holidays, again, travel companies make most of their money. So again, all these cycles, these are just a few of seasonal or calendar cycles that happen during certain periods of the calendar year. So they're not always consistent. Therefore, how do you trade them? Well, you look at these times, you're still going to look at these times to make trades in companies that would have these times being very, very special times for them to make money, to where we would expect a surge in sales. But you've got to be able to read a chart and not just a calendar in order to determine what you expect is going to happen during that time. All right, again, this is just one of the energies, but this is something you can do throughout the year, is to choose which stocks, which markets, which commodities you want to be trading at different times of the year. The second type of cycle is volatility cycle. This is a very, very important one, especially if you're an options trader. But even if you're not an options trader, all traders need to know this. But for options, volatility is absolutely astronomical in your evaluation of options. So I call this the ex-con trade, and that stands for expansion contraction. So markets have a cycle of going through high volatility, where the range of the markets from highs to lows, as their swings go up and down, become very volatile, high range, cover a big range of price. And then they tend to start dying down. The action starts to die down, then we get into a contraction phase where the range of the market, the price range, becomes more narrow. And then after that, go back into a high volatility. So this is a cycle that's very, very powerful, one of my favorite cycles to trade. Now, most people get this backwards. So a lot of people, not even knowing they're trying to trade this cycle, but what they'll do is they say, great, I want to trade a stock or futures market, commodity, whatever, Forex could be, where the market's really moving. Right? Because if the market's moving, covering a lot of range and price, then we can make a lot of money. And so we want active markets. So they'll pull up their favorite scanner, and they will scan for markets that are high volatility. That's a mistake. That can be a problem. That can lead to problems. And here's the why. Because they may not, again, have been taught of the expansion-contraction cycle. So what happens quite often is just about the time that the markets have been in a high volatility condition, and it has to take a little while for that for it to show up on a scan. So while there's enough data to create that, then you're often just about at the end of that high volatility cycle, and the market is often about to go into a low volatility cycle. So they get in, and then all of a sudden volatility drops, and they wonder, dang, what happened? Again, it's just like trends. Like as soon as I get into a high volatility market, all of a sudden the volatility gets sucked out of the market. Right, because again, they don't know how to time their entries. They've maybe never been taught about this cycle. So I like to do it the other way. Because if you scan for volatility trades, you're going to often get in right when contraction sets in. So I do what's called trading inside of contraction. So let's take a couple of quick examples that would probably be familiar to most of you. Bollinger Bands. So Bollinger Bands, they measure volatility. So I love trading Bollinger Band squeezes, right? And certainly nothing I made up. John Bollinger, great guy, wrote a good book, highly recommend it. And so we're looking for those Bollinger Band squeezes where the Bollinger Bands get close together, low volatility, we're looking for a breakout. The trick is, the key is, you've got to know which way the market's going to break out. That's where a lot of people have challenges. And what we do is we look at the next higher time frame and we look at momentum on the next higher time frame to help us to know which side of the market it's going to break out of. So that's one example. Another example would be, so you can actually scan for low volatility markets. And then by the time, again, you've got enough data accumulated to actually show up on the scan as a low volatility market, you're getting close to the time for the market to then go into expansion mode. And that's exciting. Those are fun trades because, boom, the market takes off, it explodes, and you make a lot of money fast. And fast money's fun. Another one I love is triangle trades. So two typical ways of trading triangles is one is just on the breakout of the triangle, which I never do. But, you know, it can work. It can work. But you get a lot of fake outs today. I think we get more. See, I've been trading for 49 years. I've seen a lot of changes. I think we're getting more fake outs these days than we've ever gotten before. So I don't like doing that personally. Another one is you wait for the market to break out of the triangle and then what's called a throwback. It's not called a retrace in this context. Technically it's called a throwback where it comes back then to the triangle trend line and then bounces off. And that can be a good trade. The problem is you don't always get the throwback, so then you miss out on good opportunities. The third way to do it is the way that I prefer to do it, and that's to trade before the breakout. So I'm still doing what I call a breakout trade, but I'm getting in before it breaks out. So I'm trading inside contraction. So if you get your trend lines on the top and the bottom, if the market's going to go up, I'm trading off the bottom of the inside of the triangle. If the market's going to go down, I'm trading off the top trend line inside of the triangle. So I'm in before the breakout traders, I'm in before the throwback traders, and what that does is it gives me a better risk-reward ratio, and this really is in line with the hallmark of all professional traders where we get in early. We're in before the retailers. And so we're talking about things here, like I said, triangles, Bollinger Band squeezes, wedges, etc. There's also an intraday volatility cycle that most people are aware of. This is a meta pattern. It doesn't happen every day, but it does happen most days. So for those of you who are day traders, we usually have high volatility in the morning, low volatility during lunch, high volatility in the afternoon. One of the trades I always look for is the end of lunch trade. I'm looking to get in after lunchtime. And I look to make sure that there is a low volatility chart pattern, and then I'm looking to get in, boom, after people get back from lunch, look for a big move, and that's a trade I look for every single day. Works very, very well. I encourage you to check that out. Now, here's a cycle that very few people talk about. Very few, but it's really, really important. And this is one reason I see a lot of people losing money in the markets, because they've never been taught this and they don't know how to read it. So, order chaos cycles. This is a cycle where the market at times is moving in a very orderly manner. So this is where you get your nice symmetrical higher high, higher low, higher high, higher low, very orderly pattern. Other times, the market is just moving in a very chaotic manner. It's putting in higher highs and then lower lows, and it's just maybe just going sideways, and that's, you know, traders often call it choppy market conditions. So the market does both. You know, there's a famous book called Random Walk Down Wall Street. I'm sure you've heard of it. And so a lot of people do believe the market is a random walk. It's very efficient. All the information that can be known about a market is already known, and therefore you cannot establish an edge. That's the premise, basically, of the book. Then there's other people who say, no. The other extreme is people who say, no, the market's perfectly orderly, perfectly predictable. There's all these mathematical patterns that we can look at, and these kind of people say that you can actually predict the market, and you'll hear some people say, oh, I've predicted where the market would be to the day and time and penny 10 years in the future. All right, so there's people who do that. I read both of those points of view, studied them both in great depth, and was actually very impressed by both of them because they both had very, very good points. And with my experience, I could say, yeah, you know what? This random walk thing, it's got a lot to it. There's a lot of truth to that. And then I'd look at the people who talk about the market being very mathematical and orderly and geometrical and all that, and I'm like, you know, yeah, I can see that too. There is truth to that. So then I got kind of confused because I thought, wait, how can both be true at the same time when they're diametrically opposed views? And that's when I realized. Both views, by the way, they still stand. They both still have followers because they both do have merit at different times. It's a timing issue again. Sometimes the market is a random walk. It is just chaos. There is no probability scenario to be established. Other times, the market does move in a very orderly geometric pattern. And so this is another cycle. And this is why, by the way, overtrading is the cardinal sin. I see more people losing money for this reason of just trading too much. And here's how people experience this commonly. They'll say, well, I've been trading and I've been making some money here for a few days, a few weeks, whatever. Everything's going along great. Hey, I'm the master of the universe. Oh my gosh, I'm the greatest trader that ever lived. I can do no wrong. And they're excited. And then all of a sudden, bam, they get smacked in the face by the market. And all of a sudden, trading the exact same way, nothing is working. And they lose money, they give all their winnings back, and sometimes more. And they wonder what happened. Well, here's what happened. When they were making money, the market was in an orderly cycle. It was making orderly patterns, which are rather predictable and easy to trade. Then all of a sudden the market went into a random walk period. And there's no probabilities that can be established during a random walk period. You can't make money. If you do, it's just luck. And they didn't know, they didn't understand. No one's taught them that, oh, there is a cycle between orderly markets and chaotic markets. And so they keep trading through the chaotic market cycles, not even knowing that it exists. And that's when they give all their money back. So it's very important to learn how to determine when you're in an orderly market and when you're in a chaotic market cycle, so that you don't trade during the chaotic ones and you only trade during the orderly market cycles. So that's, by the way, how do we do that real quick? Obviously, you know, I'm covering a lot here. We don't have the time to go into the how-to and all this stuff. I do that on other webinars where we just take one topic. But the foundation of an orderly market is those 5 energies I talked about, waiting for those 5 non-correlated energies to all be bullish or all be bearish. That's when the market moves in an orderly manner. And what causes that is not the indicators. What causes that is professional involvement. Professional traders who come in with size. And professionals, we trade very methodically. We have an orderly plan. And so the charts reflect the mentality of the professionals' orderly plans. Now, in a chaotic market, you've got just amateurs trading. And amateurs, they don't have that. They trade scared. They're overwhelmed by fear and greed. They're in, they're out, they're getting stabbed out, they're making the wrong decisions. So the market, the patterns of the charts reflect the mentality of the amateur traders. The next one is the coupling and uncoupling cycles. And again, this one is very well known. So this is where you use a benchmark such as the S&P 500, probably the most commonly used benchmark. It used to be the Dow 30, but it reflects too few markets now, so most people have gone to the S&P 500 to use as their benchmark. And what we do is we look at various sectors, industries, countries. You know, it's so great now with exchange-traded funds. You can trade the economy of markets of different countries around the world, currencies, obviously, forex, commodities, interest rates, bonds, all that kind of stuff. So we've got all of these different markets we can look at. And this is a huge advantage that we have access to all these markets now. And these markets, these various markets, will couple or uncouple with the S&P 500 from time to time, meaning sometimes to be moving with it and generally moving in the same direction, generally putting in the same price patterns. And then there'll be times when one of these markets will completely uncouple from it and do something completely different. S&P could be moving up, and all of a sudden another market, boom, starts going down. So that's a thing to be looking for. These cycles provide key opportunities for trades. And the way to trade this is not to trade the coupling. I mean, you can trade the coupling and just trade the relative strength, which one is stronger or weaker. That's a common way to do it. And that's fine, but in my opinion, there's more money to be made trading the uncoupling. But the key is, as always with professional trading, is to do it early, to do it earlier. So we're watching the relative strength to outperform the S&P 500. This is, everybody's big goal is to outperform the S&P 500, so you can do it that way. I prefer, and I'll do some of that, but I prefer to find a market that uncouples. The reason is because when it uncouples, it usually does it dramatically. It usually causes a big move, and it's a dramatic event that everybody knows, and I'd rather be where I can make not just a little bit more than the S&P, but a lot of it more. And the final type of cycles we'll talk about today is the very common up-down cycles. Markets tend to make bigger price moves and spend more time, there's your price and time again, in the direction of the trend, and then make smaller moves and spend less time against the trend. So up-down cycles combined with volatility cycles. Now, we always use the up-down cycles. Okay, always want to buy a cycle low, short a cycle high, because I want to get the best price. I want to buy it wholesale, not retail. So you can now use the up-down cycles and combine it with these other cycles. So you combine it with volatility cycles. And then you can also combine the up-down cycles, the highs and the lows, with the order chaos cycles. You can combine it with the calendar cycles. And this helps you see these volatility cycles, order chaos cycles, calendar cycles. These are big picture mega cycles. The up-down cycles, the high and low, swing highs and lows, those are your little macro cycles. So, micro cycles. So we're combining the micro cycles with the macro cycles to provide precision entries, a cycle inside of a cycle. So here's basically an up-down cycle. So the first rectangle there, you'll see that we have from a cycle low to a cycle high. See, the range of price is big and the time it takes is long. Then when we get our down cycle, since this is an uptrend, and that's really just down half cycle, so it's a half cycle up, half cycle down. A full cycle would be measured from low to low. It spends less time going down and less price going down. All right, that's called rate translation, by the way, in cycle analysis, rate translation. And here's another example. Cycles are the rhythm of the market, like the inhale, the exhale. Markets don't typically go straight up or straight down. They kind of, wiggle up and wiggle down. And so we'll use these cycle lows to take our entries and get wholesale prices in an uptrend. So let's finish up here, and maybe I can take a question or two. Everything works sometimes. Nothing works all the time. There's no certainties in trading. We're only trading probabilities. But with your money on the line, what you want to know is, will it work this time, meaning this trade? So all I do is wait for the alignment of the 5 energies that I listed for you to put the odds on your side. And here's my trading method. It's real complicated. It took me a long time to write this out. It takes a whole sentence. We're looking for a trend that is strong, momentum, so you don't get stopped out. Then at the right time, with support at your back, and then confirmed by the bigger scale. And that's all I do. Very, very simple. By the way, my trading method used to be really complicated, and I was real proud of how complicated and sophisticated it was. I thought it was all that because I was like, ooh, look at all these cool, this cool stuff I'm doing and how complicated it is. Then I went out to the Chicago Mercantile Exchange, got mentored out there by a guy who was making 5 figures a day, I'm like, well, I'm making money, but I'm not making 5 figures a day, so I'll give him a truckload of money, back up the truck and pour it into his garage and see what he's doing. And so sure enough, we went to the CME. He had an apartment out there, worked with him. What he and his friends, I got access to his friends who were traders there too, what they were doing was just brain dead simple. It was embarrassing. I actually thought I was going to go impress these guys with my sophistication. No, they were not impressed. They're like, yeah, you're trying way too hard, dude. This is not necessary. In fact, it's too complicated, too confusing. Here's all we do. And I was blown away. And so now I've simplified my method, and it works better, and it's easier, and it's less stressful. So just going to show one chart here today, and then we're done. This is, we're just about, time's just about done here. I got like 2 minutes. So just show you real quick. Here's the 5 energies. This is a little checklist. This is it. I trade this little checklist. Market's going down, down, down. We cross above the 50 MA, which is the red line. That's your first retrace in a new trend. Love the first retrace in a new trend. Energy number 2, momentum. Momentum is above 0. It's a strong trend. I'm still interested. Energy number 3, cycle. Here's the cycle indicator. Goes down, comes up. Great. That's the time for the market to make a low, to put in a swing low. So we got a 3 out of 5. 4, support. That red line's the 50% retrace. So we've got support. 5, go over to the next higher time frame. And trend is down, but I don't care about trend on the longer time frame. All I care about is momentum. Momentum is screaming up, and therefore we got 5 out of 5. All 5 energies are bullish, and therefore I would take that trade every day of the week. Well, actually I do. So let's finish up here, give you your freebies. The market's, or this trading method's very robust and adaptable, by the way. I use it on stocks, commodities, options, currencies, and futures, and I do trade all 5 of those markets with this same method, because all we're doing is measuring the order flow in whatever market, and by the way, whatever time frame. So I manage a pension plan, and I use it for that. I do swing trading, I use the 5 energy method. I day trade, I use the 5 energy method. So here's my information, and like I said, I've got nothing to sell today. Unfortunately, I messed up. But I do have a freebies for you today, so here it is. Let's see, I'm going to tape this link into the box here, in the chat box. I know if you're on a mobile device, you can't see the chat box, but if you're on a desktop, you can. There it is. It's a clickable link. And so if you're on a mobile device, you still can see the URL there. And what I'm giving you today is a free 5-day video correspondence course, meaning you're going to get a video from me every day for the next 5 days. And this course, here's the topic of the course: how the pros trade different than amateurs. So I've talked a lot about that throughout here. I've made references to how pros trade and how amateurs trade. That's what this course is about. If you want to know how we trade differently than amateurs, we go into more detail in this. 5 videos, interactive quizzes at the end. I give you one of my favorite trade setups, so you can actually go and trade that thing. And also, if you sign up, I give you my invitation to my next webinar. And on that one, I'll give you the cycle indicator I talked about. That's a free webinar also. The cycle indicator will be given to you for free, and a tutorial on how to trade it. So all that absolutely free. My gift to you for being here. There's the link. Thanks everybody for being here. Unfortunately, I don't have time for questions, but if you do have questions, feel free to email me, Barry@topdogtrading.com. It's right there at the top of the screen. And I love getting questions from traders, and I'll be very, very happy to answer any questions you have. So thanks to Investor Inspiration. Thank you to all you guys for being here, and enjoy the rest of your day.